In today's video, I will be covering how you can sell your IFA business. If you haven't already watched our video on how to value your IFA business, you might find this useful to add to your watch list. Most financial advisors spent most of their career building and scaling an IFA business they are proud of, which is why you will rightfully want the best outcome when you come to sell it. For this reason, you want to get it right to make sure you are securing a favourable outcome for you, your clients, and where you have staff for them as well. With this in mind, let's move on to what questions you should ask yourself before starting to sell your IFA business. Firstly, it's good to know what a desirable IFA business looks like. There are certain aspects within IFA businesses that owners are not always aware of that could affect the sale. This could be high risk areas of investment, namely defined benefit pension transfers, where the acquirer doesn't want to take on the risk of past advice, or occasionally even be associated for reputational risk with taking over some DB transferred assets for servicing. However, this is where a good broker should still be able to find a buyer, even if you do have DB transfers. A top tip from me is to provide an anonymised list of pension transfers with details of the amounts transferred, seeding scheme, age at transfer, and the rationale behind the transfer. All of this will be helpful right at the start for a high level analysis, and it will save time in deciding which acquirers are ruled in or out. Secondly, does your business meet the minimum criteria set by some acquirers? It is common practice for acquirers to set out the types of criteria that vendors must meet to deal with them. This could be a minimum or a maximum levels of recurring income or funds under management. It could be the average investment amount per active household, or the maximum age of clients, the investment plan type such as bonds or platform based, or a number of other factors. One thing is for sure, but it is an important step to know the minimum criteria before talking to any relevant parties, as it can save time for everyone involved. Thirdly, are you ready for the process? Unfortunately, selling your IFA business is not always a straightforward process. Here at IFA Acquisitions, we have brokered the sale of many businesses year after year, and from our experience, the process from start to finish can take from 3 months to 6 months and occasionally take over a year. There can be twists and turns with deals, so make sure that you are prepared for everything. Having readily available MI and well organised electronic files will make it easier for due diligence, and it will speed up the process. Don't forget to factor in delays experienced with the FCA in approving change of control where this is necessary for share purchases. Furthermore, are you sure you're ready to sell? We occasionally experience IFAs who thought they were wanting to sell, then they pull out right at the last minute, despite the deal terms meeting all their criteria, because emotionally they weren't ready to give up advising yet. The excuse often used when pulling out of a deal is that if they'd stayed on for another 3 or 5 years, they could have earned the payout terms from recurring income received. What is being missed here is 1. Rarely does the IFA receive net income similar to the recurring income after operational costs and tax on getting the profit out. And remember not to breach your own rule, which is the optimum age to retire and maximising the period of time in healthy retirement. You just simply can't buy back those years that you spent working. Selling your business is highly emotive time, and for this reason we recommend that you take your time deciding if this is the right time for you. A good broker will work with you to your timescale, and whilst challenging you on what's best for you is sometimes good, don't use a broker who you feel is pressurising you. You should think about any impacts that selling or staying will have on your personal life, including your partner or family, and remember that selling whilst you are healthy is better than doing this at a time of poor health. This is a topic we covered in far more depth in our free to download ebook, Are You Considering Your Exit Strategy?, which is a well worth read if you are considering retirement. What are some of the different ways to sell your IFA business? The first option could be through an online website, which is a way that a few IFAs may choose to sell their business. These websites will offer to advertise your business, sometimes for an upfront fee, although often fee-free with a charge upon completion, which is usually a percentage of the final asking price. Fees can massively vary from website to website, and many will apply a one-size-fits-all approach. Although some may have success with this method, we think that it is a risky approach for several reasons. Firstly, customer service with these websites can be non-existent, which is the last thing you want when trying to navigate an already difficult task. On top of that, where these are usually generic business platforms, there is unlikely to be any financial services industry experience help available. Secondly, many have a shortage of industry followers, so lacking the ability to reach suitable IFA acquirers that matches your needs. Thirdly, there is much more risk that the sale of your business becomes common knowledge, which will be discovered by clients and staff. Though this activity may well get a result, we would still be wary of this method, so if you do choose to go ahead, make sure you know what you are paying for and the type of unwanted exposure you might receive. The second option is by direct approach from IFAs. This can be a useful method of receiving reactive interest from an acquirer. However, most of these approaches do come from aggressive consolidators which swallow up smaller firms, and this will prevent you from having the ability to compare and contrast with other potential acquirers. The third option is to use a specialist IFA acquisitions broker. The optimal way to sell your business in any industry is by seeking a specialist who is versed in your sector, and the benefits are multifaceted for this option. A specialist broker should already have a selection of suitable businesses for you and can get to work right away on finding the most appropriate acquirer for you. They can also help with the whole process far more efficiently than other non-specialists. Dealing with those who are highly experienced in mergers and acquisitions and experience in the financial services market can save so much time and stress knowing that you are speaking to fellow industry peers. For example, the IFA acquisitions team here have had careers in financial services for over a combined 100 years and have had a variety of senior roles, including director and board level. One piece of advice we would give is to make sure the broker you use has non-disclosure agreements in place with acquirers and limits the number of introductions to one or two that best meet your criteria. Without an NDA, you can risk your clients and your employees finding out that you are in the selling process, which could unsettle them and potentially they could leave. This could put your business in a weaker position when it comes to its sale, leaving you open to a lower asking price than you were expecting. Again, this is something we ensure is in place at IFA acquisitions, and through thorough fact finding, our recommendations will narrow down on the acquirers that best meet the needs of all stakeholders, such as your clients, you and your staff. Think of this as a three-legged stool, and if one of those stakeholders is not supported, the stool will not be fit for purpose. We see this as a vital part of our best practice. If you do want to have a chat with us, please get in touch. Did you know that IFA acquisitions do not charge a fee to sellers, as we get remunerated by acquirers through a finder fee? Therefore, you get experts who are experienced at brokering deals with over 100 acquirers on our books, and it's a free, confidential service. The final option is through someone you know. This could be a friend, family member, business partner, acquaintance, or a current locum, etc. In some cases, your business partners may be willing to buy your equity from you. This would obviously be an ideal world where they have the capital to do this. However, often this is arranged under a long earn-out, which means this route could see you waiting longer to be fully paid out of your capital. And this is dependent on smooth and amicable dealings for many years in the future. Things can change these deals from being great at outset to problematical in future years. For instance, where the individual brings in other partners, gets ill, may die, or decides to sell the business further down the line. In other cases, you may personally know someone unrelated to the business who would be interested in taking ownership of your firm. This again is dependent on a range of factors and is extremely rare in what we have seen over the years that the deal is priced at market rates. So whilst a viable option for many, it is worth noting that unfortunately we have also seen this route as putting a strain on future personal relationships. Once you've decided on the method of your sale, you can then decide on the type of sale you want. One option is a share sale. This is where the individual is buying the shares of the business and the acquirer will then own its assets and its liabilities. The purchase is between the company shareholders and the buyer of the shares. Buying shares buys everything to do with the business, including the risk of future claims from past advice, so this can represent a contingent liability that may come with that. With share purchases, business owners should be able to benefit from business asset disposal relief. Many will still think of this as the previous name, entrepreneur relief. Meeting the criteria set out by HMRC can be useful to sellers of limited companies when reducing your capital gains tax. The HMRC website will set out eligibility. Furthermore, your business can undertake a seamless transition from you to the acquirer as they are buying everything including the client fee agreements already in place. There are ways to protect the acquirer from past risks, such as taking out run-off cover or warranties in contracts to cover any excesses on future claims for a limited period of time, usually 3 to 5 years. An acquirer will often transition clients to their existing business and then liquidate the acquired company with the approval of the liquidator and the FCA. Despite the positive aspects associated with share sales, it can have some potential downsides. For example, they can become trickier if you want to retain certain assets post-sale, such as freehold or leasehold properties or company investments. Due diligence with share sales will be more in-depth. There will be more extensive legal documentation for a share purchase than an asset purchase. The seller should expect to have to provide more warranties and provide sometimes a personal guarantee. For this reason, we encourage that you do a deep dive on your own business, as this will help you identify any potential stumbling points before you start talks with brokers or buyers. We would encourage that you think about which option would be your preference before starting to sell your business, so that there are no surprises for either of the parties down the line. However, I would always recommend that you do keep an open mind and weigh up the pros and cons of both methods when speaking with professionals who are well versed in buying and selling IFA businesses. The second option is an asset sale, which is where an acquirer buys some or all of the assets of a company, i.e. they're buying the client bank, without assuming any of the prior risk and advice liability. The seller will retain legal ownership of the business, and although the company won't be trading after the sale, they will need to keep it active over any deferred sale period, and then they will apply for liquidation and winding up themselves. Asset sales are beneficial, as stated by So Legal, who say the asset sales can make for a quicker sale as there is less due diligence for the buyer to perform in an asset sale. Thus, the transaction can often be completed quicker. The other good news is that asset sales for sole traders and LLPs should qualify for business asset disposal relief, so this is a win all round. A smooth transition is still possible with asset sales, as this usually requires the seller to get clients to sign new advisor agreements to transfer the assets under advice to the new acquirer. And in my experience, vendors are very comfortable doing this, and it gives them a chance to endorse the reasons why they chose the acquirer's business to look after their clients for many years to come. This intervention will generally protect clients from leaving and avoid future adjustments in the final consideration price. So to recap, what are the differences between a share sale and an asset sale? Newton solicitors say the main difference between a share sale and an asset sale is that in a share sale, the buyer is purchasing the entire entity, which will include all assets, liabilities and obligations, whether the seller is aware of them or not. For an asset sale, the buyer purchases only the assets of the business from the company or individual that owns them. As a broad generalisation, the seller is likely to prefer a share sale and the buyer will often prefer an asset purchase. The different tax treatments and risks involved in a share sale versus an asset sale can affect the price. To conclude, selling your business is a huge decision and not one that should be taken lightly. Of course, it is a topic that can't be definitively covered in a video like this, as all businesses and individuals are unique with differing circumstances. Ideally, your IFA acquisitions broker will be there for you throughout the entire journey and will be able to talk through all different options. They can also pinpoint areas that you should discuss with professional advisors, such as accountants and solicitors. Thank you for watching this week's video, and remember to subscribe to the IFA Acquisitions YouTube channel and turn on all notifications so that you can be made aware when we post a new video. If you want a free, no pressure chat or just more information, our contact details will appear on screen now.